In this lecture, I want to talk about the strategy known as covered calls. Now, as I mentioned in my book, Covered Calls Made Easy, this is one of my favorite strategies. I've used it to make hundreds of thousands of dollars over the years. And it's really where a lot of people start with options. It's a very conservative strategy. So people will often say that, trading options is risky. Well, selling covered calls is actually more conservative than being long a stock, simply because when you enter a covered call position, you buy the stock and then you sell some calls against it. And you collect a premium up front by doing that. And that premium cushions you in the long stock. So if the stock were to fall, you won't lose as much money on a covered call position because you've already collected some cash up front. So what is a covered call? A covered call, you basically buy 100 shares of stock and then you sell a call against it. You sell short a call, you sell to open a call, you basically sell a call that you don't own. And usually you'll do this right at the money or slightly out of the money. Now you can also sell calls against a stock that you already own. And typically what you'll do, either way, you either buy the shares of stock or you already own the stock, and then you sell one call option for every 100 shares of stock that you have, simply because we want these two things to offset each other. Again, as I said in a previous lecture, selling a naked call or being short a call is a risky strategy, but selling a covered call is a conservative strategy. And your broker will treat it this way as well, simply because there's not unlimited risk if the stock goes up a lot, as there is with a naked short call. Now, what are some of the benefits of covered calls? Well, they can be a great way to generate monthly or multi-month income. As we said, they can also reduce your maximum loss on a stock position simply because you're collecting some cash up front, which helps to cushion your downside. And you can also, the nice thing about covered calls is you can make money in a stock that is going sideways, that's not really going up, that's not really going down. And so it's a way of sort of monetizing a stock that's trapped in a sideways position and making money from it. Now, what happens when you sell a covered call? Well, you're basically giving away the upside past a certain point, which is that point is going to be the strike price of the call that you sell. And then in exchange for giving away this upside, you're going to get paid some cash up front. It's a credit trade, so you can get paid premium up front. Like a naked short call, this is a positive theta trade. So after you sell that call, if all else is equal, if the stock doesn't move a lot, if nothing else really happens, you'll make a little bit of money every day from time decay, from the theta decay. And that can be very satisfying. It's nice to have strategies where you make a little bit of money every day. Much more pleasant psychologically than strategies where you lose a little bit of money every day. So generally, I like to sell calls at the money, as we said, or slightly out of the money. And then in terms of expiration, I like to go out 30, 60, 90 days. And the reason for this is the last 90 days of a stock option's life, of a call option's life. That's when the most time decay will happen. And because we're short a call, we want that time decay to happen. Obviously, it happens the most in the last 30 days. But I find this to be a sweet spot, going 2 to 3 months out and roughly at the money or slightly out of the money. And we'll look at a couple examples soon. So here's an example based on where Coke is currently trading. The Coca-Cola Company, ticker KO. Right now, today, you can buy 100 shares of Coke for $53.78. So to buy 100 shares of Coke at $53.78, that will require $5,378, assuming no commissions, if you do this at Robinhood. And then after we bought that 100 shares of stock, we're going to sell one call against it. And one call simply because one call is the equivalent of controlling 100 shares of stock. So we're going to sell a call. We're going to sell to open a call that is just the next strike price up. There's no really at the money call here. I think sometimes Coke would have a 52.50 call, but really the closest call right here that's above the current stock price is 55. So we're going to sell a 55 call. These are the calls that expire December 20th, 2019. And we're going to sell that call. The price of the call currently is 1.07. Now, you collect, because you're selling one call, you're going to collect $107. That's just 1.07, the price of the call times the 100 multiplier. So you'll get this credit up front in your account. Now, what happens while you're owning this call? Well, I picked the strike price for a particular reason. Today is October 11th, and so this call option expires in a little bit more than 2 months. It's roughly at the money, slightly out of the money. And the other reason I picked this expiration is it will allow us to collect the dividend, a dividend payment, a quarterly dividend payment that Coke currently pays. So let's take a look at that by going to, what you can do is you can just type in, go to Google, type in when does Coke go ex-dividend. Now, the ex-dividend date for a stock is the day on which you will no longer get paid you'll no longer get paid the dividend if you own the stock. So the most recent ex-dividend date, let me scroll in a little bit here. You can see Coke just went ex-dividend on September 13th, 2019. So what that means is if you bought the stock on September 13th, you do not get paid this quarterly dividend. But if you bought it the day before, on September 12th, if you owned it as of the day before, you will be entitled to this 40-cent dividend payment. Now, if we scroll down here, we can see that we don't know exactly when Coke is going to go ex-dividend, but we can see that last year in 2018, it went ex-dividend in the fourth quarter on November 29th. The previous year in 2017, it went ex-dividend on November 30th. And let's see, the previous year, November 29th. So we have a good idea that it's going to go ex-dividend at the end of November. And so that's one reason, rather than selling a November call, which would expire the third week of November, the November monthly calls, I decided to go out another month to enable us to get this 40-cent dividend. It's another $40 on 100 shares, just 40 cents dividend a share, and so that will add to our return, our potential return on this trade. So we're going to collect $107 by selling that call, and also just by holding that stock over that period through the end of November, we'll also be entitled to that dividend payment, which that dividend payment probably won't show up in our brokerage account until early January. There's always a lag. Now, what will happen in this trade? We basically bought 100 shares of Coke. We've sold a slightly out of the money call. What are the different scenarios here? Well, if the stock is at or below 55 at expiration on December 20th, 2019, that call is going to expire worthless. It's going to expire out of the money, so it's going to have no value. It's going to have no intrinsic value. It'll have no time value left because it'll be at expiration. And we'll just get to keep that $107. We'll still own the stock at $53.78. And so what's our total return? Well, our total return is just the call premium that we collected, $107, plus the dividend payment that we collected of $40. So that's $147 returned, and it cost us $5,378 to buy the 100 shares of Coke at $53.78. So that's a return of 2.73% over just 71 days. Now, if we annualize that, it's looking pretty good. It's roughly 14% annualized if you could do the same trade every 71 days. Sometimes you'll be able to, sometimes you won't. Now, what's our break-even price? Well, our break-even price would be the price of the stock, the price we paid per share, $53.78. And then we got some credits. We got a dividend payment of 40 cents per share. We got a call option premium of 1.07. So we're just going to subtract those from the purchase price. And that's our break-even price. It ends up being $52.31. And so what that means is the stock can fall $1.47 and we still don't lose money. In other words, the stock can fall 2.73% and we'll still break even on the trade, which is very nice. Now, what's our max loss? Well, our max loss would just be everything at and below that break-even price. So we paid $53.78. We collected $1.47. So we basically have $52.31 in per share. And so if Coke goes to zero, which is highly, highly, highly unlikely, it's a very stable, very old company, not a super volatile company. But if the stock were to go to zero, our max loss would be the stock going from $52.31, our break-even price, all the way down to zero times 100 shares, which we own. So $5,231. That'd be the max loss on the trade. Now, what happens if the stock is above 55 at expiration? In this case, we're short a call, so what's going to happen is the stock is going to be called away from us at expiration. What's technically going to happen is we're short a call, so at expiration, after expiration, we will be assigned a short position in the call, a short position of minus 100 shares of Coke. And so it'll be like we're short Coke at $55 a share. Now, we already know that we bought 100 shares of Coke at, $53.78. So if we're long 100 shares of Coke at $53.78 and we're short 100 shares at 55, the broker is going to cancel those two things out. You can't be long 100 shares of the same stock and short 100 shares of the same stock in a brokerage account. So what will happen, essentially, you'll be selling the stock at 55 at the strike price of that call option. The stock will be called away from you. The call option will disappear after expiration. So when you wake up that Monday morning, you will have sold the stock at 55, the same stock that you bought at $53.78. It will have been sold at 55. You'll have some cash in your account. You'll basically have 55 times 100 shares, so $5,500. And the trade will be done. You will have collected, and let's see what the return will have been. You will have collected $107 just by selling that call, collecting that premium up front. You will have collected $40, though that $40 might not be paid for another 30 days. So I'm sort of looking at what our total return would be maybe a month after expiration or so. It really depends when that dividend payment shows up in your account. Now, we also have a short-term capital gain on the stock itself. We bought Coke at $53.78. We were forced to sell it at 55 at the strike price of that call option. So we made 1.22 points on 100 shares, which is equal to $122. Not counting commissions here. If you use Robinhood, there's no assignment cost as well. So our total profit is basically premium collected by selling the call, dividend collected, and then that short-term capital gains of $122. So the total for this is $269. $269 divided by what it costs us to put the trade on. We need to have $5,378 in our account. That's a 5% return over just 71 days. And really easy way if you need to calculate how many days to expiration. If your broker doesn't tell you, what I did is I just said how many days between today and December 20th, 2019. This might be 1 day off or 2 days off, but it gives you a rough idea. And so a 5% return over 71 days, if you could do that every 71 days for a year, that's approximately 25% return annualized, which is that's a really nice return, considering the S&P is made about 10, 11% annualized. So you'd definitely be beating the indices at that point. Now, what happens if you want to keep your shares at expiration? Well, if that call goes in the money, especially going into expiration, you know that those shares are going to be taken away from you. And you'll be assigned that, as we said, you'll be assigned a short 100 shares, which will cancel out your long 100 shares. If you want to avoid this, a couple days before expiration, you need to buy back that call. So maybe you've changed your mind. You sold a call against Coke or against Apple, and you've been reading more about the companies, and now you think, wow, they actually have the potential to go up for a few quarters here. In that case, you don't want to give up your upside by being short a call. So you want to buy back that call as soon as you begin to believe that there's some real upside to the stock. And if that call is in the money, there's a good chance, especially if there has not been a lot of time decay, there's a good chance you might have to pay more for that call, buy to close, than you collected by selling that call, sell to open. And so you'll actually have a loss on that short call position because you will have sold low and bought high, bought the call option back at a higher price. So you'll lose money on the call option, but you will have made money on the underlying stock moving up. Now, doing stuff like this, and actually any sort of options trading, can create some tax issues. And the tax law on this is changing all the time. So I'm going to give you a link, but I want you to make sure this is the link. This is a link from Fidelity, Tax Implications of Covered Calls. But again, these things change all the time. So make sure you consult your tax preparer or accountant before doing any strategies in this course. But basically, to recap, if you want to keep your shares at expiration, if you don't want them to be called away from you, you need to buy back that call. And you need to pay whatever the market price is for that. Could be lower than what you sold it for, or it could be higher than what you sold it for. If that call has gone in the money and not a lot of time has elapsed, so you haven't had a lot of time decay, there's a good chance you're going to have to pay more to buy back that call, to close that call, than you collected by selling to open or entering that short call position. Now, as we said, covered calls should be used on stocks that you expect to sort of be flat, to not really go up or down much, or to go slightly higher. So in that case of Coke, where we bought it at 53.78 and we sold the 55 call, our maximum profit on that trade will occur if the stock is at 55 or above. So if the stock's around 55 at expiration, that's great, we've made money. If the stock is like 70 or 80 at expiration, we're going to be sort of bitter because we gave away all that upside. So again, none of us has a crystal ball, but if you think a stock is going to go up a lot over the next quarter, the next year, or over whatever time period, covered calls is probably not the best strategy for you to use. Also, if you think a stock is going to crash, or there's a chance it's going to crash, or have a bad earnings report, or there's a lot of downside, you can still lose a lot of money being short, being in a covered call position. Now, you won't lose quite as much money as if you just own the shares, because you did collect that cash up front, and that gives you a little bit of a sort of cushion. But, if we buy Coke at 53.78 and we collect $1.07, that cushions our downside a little bit. But if we think people are going to stop drinking soda and the stock's going to $10 a share or zero, covered calls is not the right position. In that case, you want to be long a put on the stock, or long a bear put spread, something like that. If you think a stock's going to go up a lot, just to review, you can always just buy the stock, not sell a call against it. You could be long a call option on the stock, or long a synthetic stock position instead. So you could sell an at the money put and buy an at the money call, or sell a slightly out of the money put and use that to fund a slightly out of the money call. So those would be more bullish positions. And again, if you think a stock's going to go down a lot, don't do covered calls on it. It's not worth it. Even if you're collecting a lot of premium, if the stocks can go down by more than that, it's not worth it. And again, you can pick the strike price of that short call based on the appreciation potential you see of the stock. So if I thought that Coke was going to maybe go up to 60, I would probably want to sell, if I thought it was going to go up to 60 between now and December 20th, I'd want to sell the 60 call instead of the 55 call. Usually, though, an at the money or just slightly out of the money, it will be the best strike price to pick. And this is because at the money call options have the highest premium, and also the highest, they have the highest time value, or the highest extrinsic value. Deep in the money options have a lot of intrinsic value as well, but we don't want to do covered calls with deep in the money options because we want to really benefit from that theta decay, that time decay. So you want to pick an option, a strike price that's very close to at the money, or maybe just a little bit above where the stock's trading right now. So how do we enter a covered call position? Well, you always want to buy the shares of stock first. Maybe you already own them, in which case you can skip this step. But you want to buy the shares of stocks first and then sell the call. And you want to use a sell to open order for that call. Now, never sell the call first, or you're basically going to be short a naked call until you're able to buy those shares of stock. So, usually something's not going to go wrong. You could short the call first in Coke, but if, for example, let's say McDonald's, you were really unlucky and all of a sudden it's announced during, you sell a short call, you sell the 55 call on Coke, and while you're trying to buy the 100 shares of stock, it's suddenly announced that McDonald's is going to be buying Coca-Cola for, $70 a share, in which case you're short a call at 55, the stock's going to move up immediately to 70, you've lost a lot of money. So that's why I would say never sell that call first, because you are taking on some sort of fat tail risk if the stock spikes before you could buy those 100 shares of stock. It's a totally different strategy doing the call first. That's really a naked call position. So let's take a look at how different brokers allow you to do this. So we'll first look at Robinhood. So let's see. We'll just type in Coca-Cola, ticker KO. And so if we wanted to do a covered call on Coke, and again, you can see it's trading right around there, 53.81. What we would do is we would first buy 100 shares of stock, or maybe we do 1,000 shares if we wanted to sell 10 calls against it. But here we're going to keep it simple. You buy 100 shares of stock. Basically, you review the order, you buy the stock, and then once it shows up in your account, I'm going to go ahead and cancel this for now. Once it shows up in your account, then you're going to want to come back to the screen and click on Trade KO Options. Then you're going to sell a call. You pick the strike price. I think we said December 20th. Stock's currently at 53.79, and so we want to do the slightly out of the money call, really the closest strike price. We could sell a slightly in the money call here, this 52.50, in which case it would have some sort of embedded intrinsic value. The problem with this is if we do this, we're allowing the stock to be called away from us at 52.50. So we'll be buying at 53.80, selling at 52.50, which is okay because we'll then be short that call. But it's better, it's a little simpler if you just do it right at the money or slightly out of the money. So we just click plus here. We'll be selling one call. So then if we click continue, we'll just do one contract for every 100 shares we own. And you can enter the limit price here. It looks like it's about 107. And then you click review order and you execute it. So at that point, you'll be long 100 shares of Coke and short one December 20th call struck at 55. So that's how you do it in Robinhood. If you want to do it in Thinkorswim, they actually make it even easier. A lot of brokers will do this, really options brokers. So let's say we type in KO here, and then we go down to the December 20th expiration. And basically you pick your call, your strike price. So we said we were going to do the 55 calls. And what I'm going to do here, on the call side of it, again, I'm looking at the December 20th here. On the call side, the strike price I want, which is 55, I'm going to right click, and then I'm going to go to buy, and I'm going to do buy covered stock. Now you'll see what this brings up. This brings up and you're going to have to adjust this. So if I just want to do, I'll click the plus sign, which is a little counterintuitive here because it's making it get less negative or closer to zero. But you can see basically what I'm doing here is I'm buying 100 shares of Coke, and then I'm selling one call struck at 55. And if you click confirm and send, then you'll see that it tells you your max profit, your max loss, etc. Your break-even stock price was pretty close to where we calculated it. Here it's 52.73. Stock's obviously moving around a little bit here in the open market. And then you just click send, and this will simultaneously buy the shares of stock and sell one call against that stock. And you can see the limit price it's using. If we go back, well, you can probably see it here. It says the limit price is 52.73. So that would be the price of the of where the stock is. And maybe it will. So 52.73. Actually, you know what? This includes the call premium that you've collected. So what this is basically doing, this is functioning like a spread trade. It's basically saying, I don't care what price I pay for the stock, and I don't care what price I sell the call for. But when you add those two together, that long stock position and short call position, I want to make sure that my max loss, my break-even stock price is 52.73, which you can see is about $1.05 below where the stock is currently trading. So that's basically the same thing being entered as a spread trade. Makes it really easy because you don't have to worry about buying those shares of stock and then quickly selling a call against it. And again, I would recommend if you're doing it, especially if you're doing it with Robinhood near the beginning of, you don't want to do this trade like in the first 15 minutes when the market first opens and there's everything's kind of moving around. You don't want to do it during an economic number or when the Fed is coming out with their latest interest rate report. And you also don't want to do it maybe in the last 15 minutes. But if you do it, kind of do it during lunchtime, maybe at, call it at 12 or 1 o'clock Eastern Standard Time when the stock, you can see Coke's not really moving around a lot here. just down 4 cents on the day. But you want to enter this, especially if you have to buy the stock and then sell the call. You want to make sure the markets aren't really moving fast, because otherwise, what if you buy the call? What if you buy 100 shares of Coke right here, and some terrorist attack happens, heaven forbid, or some market moving news, maybe a Trump tweet, and the stock drops $1 before you can sell those calls against it, that call against it, you're going to get a lot less for the call, because at that point the stock will be trading $1 lower. And so those 55 calls you won't be able to capture quite as much. So again, good time to do this is when you can see the stock. This is a daily. You can see the stock moved quite a bit in the first couple hours of the day, and now it's just been sort of chopping along sideways. So that's basically how to enter the trade both on Robinhood or a broker like Thinkorswim, which will allow you to do it as a single order. Now, what happens if you want to exit the position before expiration? Well, we talked a little bit about this. If you think the stock's going to go up a lot, or you don't want the stock to be called away from you, you basically enter a buy to close order, and you buy back you buy back that short call, or those calls that you were short. And then after you do that, if you no longer want to own the shares, maybe you just want to get out of the position and have cash, and you don't think the stock's going to go up a lot, in that case, you buy to close the call, the short call, and then you just sell the shares like you normally would. You sell the shares of stock on the open market. Now, whenever the stock price is trading above the strike price of that call, so if Coke were trading above $55 after we put the trade on, there's a chance that you can be assigned before expiration. And what that would mean is the shares of stock would be taken away from you at 55, and the call would disappear from your account. Now, this is unlikely unless that call goes deep in the money. So if Coke goes to maybe 60 or 65, and there's still some time before expiration, then there might be a higher probability of the stock being assigned, the call being assigned. Now, having a call assigned early when you're in a covered call position is actually a happy thing. You finish the trade sooner, you get your cash back, and you've made that. We talked about how we made a 5% return before if the stock was called away at 55 at expiration. Well, if it's called away even earlier, you've made a higher return because it's the same return over a shorter period of time. So it's a higher annualized return. Again, if there's a lot of time value though left on the call option, it's very unlikely that someone's going to exercise that call, simply because when you exercise a call, you lose that time value. And so assignment is, while it can happen early with a covered call, it's less likely. And if it does happen, you're very happy, especially if you're okay with the stock being called away. But again, this is why you should never sell calls against a stock that you're not happy having taken away from you, because it can happen. It can happen at any time, and that's what it means when you sell a call. You're allowing someone the option of taking that stock away from you at the strike price. Now, what do the Greeks look like? Well, the Greeks are less important for covered calls, but you should know that you're still basically short Vega. If implied volatility moves up a lot, the value of that call will move up a lot. You're short the call, and so you'll lose some money on paper. And again, the underlying stock, the 100 shares of stock, those are not going to be affected. Their pricing is not affected by implied volatility. As we said, covered call positions, time decay works in your favor. You're short a call, it decays a little bit. It's the melting ice cube, decays a little bit over time every day. And so this is a long theta trade, a positive theta trade. And then we are long delta, I guess, at least up until the price, the strike price of the call. And so the stock going up does help us up to a point. So when Coke goes from 53.78 to 55, that increases our potential profit on the trade. But then above that strike price, any appreciation that is in the stock we've given away. And so at that point, long delta doesn't really help us. Now, how do you know what stocks to write a covered call on? Well, this is a complicated question. There are different ways of doing it. So I'm going to show you a bunch of different ways, and then you're going to have to decide what works for yourself, for your own risk profile, your own personal psychology, the kind of stocks you like to own. I would say, first of all, that you never want to do covered calls on a company you don't understand or that you're bearish on. So a fairly safe place to start is you can look at any of the Dow 30 stocks. So if we just go and type in, we could type in Dow 30 stocks list. These are the stocks in the Dow Jones Industrial Average. And they're all blue chip names that you really recognize. You know, American Express, Apple, Caterpillar, Cisco, ExxonMobil, IBM, Johnson & Johnson, etc. So any of these would be fine. The one thing to consider, General Electric, GE, used to be part of the Dow 30. So occasionally you'll have a fallen angel. Occasionally some of these stocks will fall on hard times and may even be eliminated from the index. So again, you should think about what you own. So if, for example, you own, you're thinking of doing covered calls on Boeing, but you have some reason to believe that people are going to stop buying Boeing planes because they're worried about the 737 MAX, or maybe there's been so many terrorist attacks that planes aren't going to be flying for the next couple of years. You know, crazy stuff like this. But always consider what the underlying company is that you own. So any of the Dow 30 stocks is fine. Also, any of the dividend S&P 500 dividend aristocrats. So one way to get this is you can just type in NOBL components. This is the ETF for the S&P dividend aristocrats. And if you go in here, you'll be able to look up the individual stock names. And there'll be a lot of familiar names in here. AT&T, Procter & Gamble, Pepsi's in here, Coke is in here, etc. So you can always pick one of these names. So that's one pool deficient, one pond deficient. Any of the Dow 30 stocks, any of the sort of classic dividend aristocrat stocks, which are stocks that have been paying a dividend for many, many years and are considered fairly safe. I like to target a dividend yield in this market environment of roughly 2% to 3.5%. Now you can do covered calls on a stock that doesn't pay a dividend. You could do covered calls on a stock that pays a higher dividend than 3.5%. But in the current environment, we're right now in late 2019, stocks that have a 4, 5, 6% dividend yield, they have that high yield simply because there's some risk associated with holding them. So for example, AT&T has a lot of debt, it pays a very high dividend, but there's a chance that the stock could crash. And at one point, General Electric, before it crashed even more, was trading with a high dividend yield, and then they ended up just slashing the dividend. Now, why do I like to target dividend stocks, sort of conservative, safe dividend stocks for covered calls? Well, this is because if the stock goes down and my call expires worthless, I'm happy to still own the stock because I'll be being paid a quarterly dividend, and then I can sort of wait till the stock gets back up to my strike price and sell more calls. So this is a target. Again, you can use stocks, really good growing companies, maybe reinvesting all of their free cash flow, all their cash flows, and so they won't pay a dividend. They'll just be investing the money back in the business. But here's the conservative way of doing this, targeting a dividend yield that's somewhere between 2 and 3.5%. Now, if the dividend yield is below 2%, maybe the stock's overvalued. Maybe it's not, but there's a chance that it could be. If the dividend yield, as we said, is above 3.5%, there's usually either some business risk to the company, or there's a risk that they could cut the dividend. I like to look at companies that are at least 10 years old. You know, when a company first comes out, especially a tech company, hard to say, you know, Snapchat comes out or Twitter or something. It's hard to say if they're going to be around we know now that they're still around, but when they first come out, you know, GoPro or something, you don't really have a good sense of whether they'll still be around in 5 or 10 years, especially in like tech or biotech. Those companies can really come or go. Again, you want to pay attention to the underlying business. You do not want to write covered calls on a company that makes faxes or typewriters or buggy whips or non-smartphones, etc. Simply because their business is going to go away, and as their earnings evaporate, the stock is going to go down a lot. You're going to lose money. You also don't want to write covered calls on businesses that are in really low margin, super competitive businesses, like maybe internet hosting is kind of a commodity business, or mining companies where there's a lot of competition, there's a lot of cyclicality. So a lot of people like to write like to write covered calls on very stable stocks. So consumer staples, Coke, McDonald's, Procter & Gamble, Walmart, Pepsi, Colgate, Palmolive, those are the tickers right there. These are things, even in a recession, even in bad times, people are going to eat at McDonald's and shop at Walmart. And maybe in bad times, more people are going to eat at McDonald's rather than eating at a more expensive place. And more people, instead of shopping at Whole Foods, people are going to start to move to shop at Walmart. So consumer staples are always a good place to fish. And many of these names will be in that list of S&P 500 dividend aristocrats. Also, monopoly tech companies, companies like Apple, Microsoft, Google, Amazon. There's a risk they may be overpriced. Amazon in particular trades at a very high PE. But so that's something you have to, that's where the sort of fundamental analysis comes in. But these are companies that are not going away. They're very firmly entrenched. And in many cases, they have monopolies and they really don't have any, like who's the competition for Google? Like no one else uses a different search engine if they can. So monopoly businesses are always a good place, especially monopoly tech. These are fairly safe companies. And, you know, if you think Amazon or Apple are going to go up a lot, again, you don't want to give away that upside by selling the call. But maybe you think they're fairly valued here. They're not going to go up a lot. They're not going to go down a lot, in which case covered calls might be a great choice. And again, you have to pay attention to valuation. Don't write covered calls on a stock that's super, super overvalued. It's also best not to pick a stock that has been going down for a while, or that keeps hitting new 52-week lows. It's on that 52-week low list, or is in a 50-200 downtrend. So you can see, for example, if we go look at what General Electric was doing a few months back. Okay, so if we scroll out here, we can see that GE was in a, I don't know why it's not loading. Let's reload this. And we'll type in General Electric, GE. So you can see here that there was a period where the stock was trading below this blue line here, which is the 50-day moving average. The blue line, the 50-day moving average, was below the red line, the 200-day moving average. This is a classic downtrend. You can see here where the blue line crosses below the red line. That's often known as a death cross. And so this was a case where the stock, you know, GE was a very well-loved company and well-loved stock. It was in a lot of people's retirement accounts. But all of a sudden, it starts hitting new 52-week lows. It's trading below the 50-day moving average. It's in this downtrend. Don't try to pick a stock that's trending down. If you must do it, let's say you're still bullish on GE, you know, maybe now would be a good time. I don't particularly like this company or this stock right here, but you can see that it's put in a bottom and it's now trading sort of sideways. And that's what we'd want to see. If you're selling covered calls on a stock, you don't want it to go down because you'll very quickly lose money. But if it's trading sideways, if it's kind of chopping sideways, you can still make money selling covered calls on it. So that's why I would say avoid stocks that are in a 52-week, hitting on the 52-week low list, or in 50, or in, you know, moving average downtrends. Now again, it's okay to jump in front of this if you really understand a business, understand the fundamentals, and think, well, the stock's been going down, but it's so undervalued at this point, and I really understand the business and its future potential and its future earnings, then it's okay. But this will really widely vary depending how much financial analysis you're able to do, financial statement analysis. If you want to learn more about that, check out my course on that. That's available to you free as a Trader University subscriber. And really learn to read balance sheets and understand the fundamentals of a company. You can see where it can give you a real advantage when it comes to covered calls. I like to look at companies for covered calls that have a 5-year average return on equity, which is basically net income divided by book value, of more than 20%. So how do we find that? Well, I'll show you how to find it for Coke, for example. What you can do is you can just go to, they're only available for the Dow 30 stocks, but if you type in value line, all one word, value line, PDF, KO, this will take you to the value line sheet, the latest sheet for Coke. And if you scroll in here, you can see that it gives you a lot of interesting information. This is a couple months old, but you can see the dividend yield is roughly where we want it to be, between 2 and 3.5%. And then if we scroll down here, there's a line, if I can go in a little bit here, you'll see at the bottom, return on shareholder equity. This is ROE, return on equity. And you can see, I just look at the last 5 years, you can see it's 30s, 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 48, 52. Clearly Coke qualifies. Now, if a company has a high return on equity, it usually means that it has a fairly good moat. It's in a good business and it's in a competitive position. Really low margin commodity businesses are not going to have a high return on shareholder equity. So that's one place you can find it. And if you take my course on financial statement analysis, I'll show you in there how to actually calculate this for yourself, so you can do it for other stocks. Now, another interesting thing that's on this value line sheet is, if you look over here under the capital structure, it says LT debt, 29 billion, call it 29 billion. That is the long-term debt. And so for the next calculation, we're going to want to look at that long-term debt number and subtract from it the cash on the balance sheet, which is basically cash assets here, which as of March 2019 was about 12 billion. So we'll take 29 billion minus 12 billion. That gives us the net cash position of the company. And so if we look at, it gives us, I should say, the net debt position. So net debt is calculated as long-term debt minus cash. So you're basically taking the debt the company has, netting out the cash, because theoretically they could use that cash to pay off the debt. And then I like to look at a 3-year average of net income and divide that into the net debt. And this gives me an idea of how levered the company is, how much long-term debt it has, and whether it'd be able to pay it off in an easy manner. So if this ratio is 4 or less, that tells you that, assuming the company's earnings power remains the same, this company should be able to could theoretically pay off all of its debt in 4 years or less. And so as we said, let's just go back to that sheet. We took 29 billion in long-term debt minus 12 billion in cash. That gives us about 17 billion in net debt. And then what we want to do is go back and look at net profit over here, which is the same as net income. You can see for the past 3 years, it's been about 8 billion. This is expressed in thousands. So 8354, 8240, 8935, these are basically in billions. I'm sorry, these are actually expressed in millions, but that's equal to, that's basically about $8 billion a year in earnings. And so if we take that 17 billion net debt divided by the 3-year average of net income, it's 17 divided by 8, which is roughly, 2 years. So looking at this, it tells us that Coke could pay off, it's got a lot of debt. I mean, it's got $29 billion worth of debt. It's a lot of money. But they also have 12 billion in cash that's available, and they're generating 8 billion in earnings roughly every year. So it'd be very easy for them. This is a manageable debt load. We don't want to pick a company that has a huge amount of debt, simply because then the equity becomes more risky, the stock becomes more risky, and these are the kind of companies that have too much debt that can theoretically file for bankruptcy. So again, 5-year return on equity above 20%. If it's 18%, that's still fine, obviously, but these are kind of rough guidelines. And if you look at the Dow 30 stocks or the S&P 500 dividend aristocrat stocks, a lot of them are going to fall within this category. But I like to look at sort of the competitive positioning of the stock, which we can tell, of the company, which we can tell by the ROE. Also how levered, how much debt it has, which we can tell by net debt divided by 3-year average net income. And then finally, you want to look at how the calls are priced. So what I will do is I want to get paid at least 1% for a covered call position that lasts 1 month. So for every 30 days, you want to get paid roughly 1%. Now, how would we calculate that? Well, there's a really easy way of doing it. We could just go back. Let's go back and let's just type in, we'll pick a different stock. We'll pick Microsoft here. So then we'll trade options. We'll look at the put. We're going to sell a call that's expiring in about a month from now. So what's today? Today's the 10th, I should say. So we'll look at the options expiring, call it November 8th. These will be weekly options. We know simply because it's not the third week of the month. But so what happens? Well, let's say that we buy the stock right here at 138.97. We're just going to call it 139 to make the math really easy. That's where Microsoft's trading. And then we're lucky here. We can sell an at-the-money call that expires in roughly 30 days for 428. So what you want to look at, this 428 divided by 139. So we're looking at the money calls. So let's see, 4.28 divided by 139. That's equal to 3%, which is good. It's about a 30-day option. And so for every 30 days, for an at-the-money option until expiration, we want to make sure that we're making about 1% on the premium. And this looks very good because we're making a full 3%. In addition, Microsoft pays a dividend, so there might be a dividend involved as well, as long as you hold it through the ex-dividend date. But that's basically what I mean here by 30-day premium, the short call premium you collect, divided by the cost of the stock. You want to look at this roughly at the money. If it's a little too far out of the money, then maybe the call option won't pay as much, but you're banking a little bit more on the capital gains. You're betting on Coke going from 53.78 to 55. So it's a balancing act. Again, the more you do this, you'll find the sweet spot for your own investor preferences. Now, one thing I should mention that a lot of new traders have problems with: don't get greedy with really fat premiums. Sometimes you'll look at a stock and the calls will be very highly priced. And as a result, those returns, if you do that 30-day return, as we just did, of an at-the-money call, you'll find that it's like, wow, I can make 10% in a month or 20% in a month or, over 5% in a month. Now, why would a stock have very expensive call options? Well, there are two reasons. One, because it's highly shorted. And there are a lot of people betting the stock's going to go down. So a lot of people buying puts on the stock. And what happens when a lot of people buy puts on a stock? It also drives up the price of the calls because of something called put-call parity, which we're going to talk about in another lecture. But high short interest stocks, highly shorted stocks, and we should remember here that short sellers are usually right over the long term. When they bet against stocks, stock might not go down tomorrow or next month, but these are troubled businesses that eventually crash. And so you don't want to be in a stock, you don't want to do covered calls on a stock that's going to crash, that people are highly short. And again, the reason these calls might lure you in is because the calls are very highly priced. And the reason is because the stock's highly shorted, or it could be just that the stock is extremely volatile. Why is it volatile? Well, people are having trouble valuing it. Maybe people are worried about the upcoming earnings, or people are worried about their business going away because of the competitive landscape changing. So I'll give you an example here. Let's go look at GameStop. So we'll go back to Robinhood. And this is you can sort of play around in Robinhood here. So we can see GameStop's trading at about $5 a share, where GME is the ticker. We're going to look at, let's just go out. Let's pick, we'll go out a little more than a month. So we'll go out to, we'll go out to November 22nd. We'll be looking at selling the calls. The stock's right at, call it $5. It's at $4.99. And it looks like we can get paid 54 cents for an at-the-money call. And the time to expiration, call it, it's about 45 days to expiration, roughly. So 54 cents. This is basically doing an at-the-money covered call. 54 cents divided by 5 is basically 10%. Call it even 11%. It's about 10.8%. And so to make this much money in 45 days, as they say, if it seems too good to be true, it is too good to be true. So in this case, you want to stay away. And if we go to a great website is High Short Interest, all one word, highshortinterest.com, you can see that GameStop is listed right here at the top as one of the highest shorted stocks, one of the most popular stocks to short. And it tells you that the short interest as a percentage of the float is very high. And so this is a stock that it theoretically could go up a lot if there's a short squeeze. But this is a very troubled company that has a lot of short sellers driving it down. It's also a stock that's been going down for a while. And so if let's say you you don't know much about GameStop and you're looking at the calls, if something like this jumps out at you, if you're getting paid even 5% for 30 days or 45 days, there's something wrong. And so you should probably stay away unless you really understand the business. If you really understand, if you think GameStop is going to be around, maybe the stock's not going to go back up to where it used to trade, but it's also not going to go out of business. People are going to keep going into stores to buy games. Then you can do it. But most of the time, the options market and the short sellers are very smart, and you don't want to go against them. You take on a lot of risks. So this is great. You can collect 10, 11% over the next 30, 45 days. But what's probably going to happen is the stock's going to go down 20% over that time. So you're going to collect 11% on the covered call position, and then you're going to lose 20% on the stock going down. And so you'll end up being down 9% on your position. And, having gotten greedy with this sort of fat call premiums, you end up actually losing money on the trade. It's a little bit like buying very high dividend yielding stocks. It looks like a great deal. Maybe you'll get one or two payments, and then the stock collapses and more than loses whatever extra premium you've collected. So don't do covered calls on high short interest stocks. You can, I forgot to mention, you can also just go to Yahoo Finance, GME. And then if you click on statistics and you scroll down, you can see short as a percentage of the float. So right here, short as a percentage of the float. They're actually, this must be a mistake, but it's pretty, or short as a percentage of shares outstanding. 68%, 69% of the shares outstanding are sold short, and they've actually shorted more shares than are available in the float. I'm not sure how that's possible. They're at 105%. This should normally be less than 100%. But this is a stock that's very, very troubled. You can see its quarterly revenue growth has been negative 14%. They're losing $10 a share. Or over the last 12 months, they've lost $10, $11 a share. The stock's only trading at $5 a share. So deeply distressed company. But if you check out here, if the short as a percent of float is 10% or more, you definitely want to stay away unless, again, you really understand the fundamentals of the company. Now, what would be an exception? Well, some tech stocks in particular are extremely volatile. Let's take Shopify, for example, SHOP. If you're comfortable, if you're very bullish if you're super bullish on Shopify, instead of doing covered calls on it, you should just be owning the stock. But if you think maybe it's going to go sideways from here, it's not going to go down a lot, it's not going to go up a lot, you can do covered calls on Shopify. And you might get paid a lot of money simply because it's a volatile stock. Its historical or realized volatility is high. And as a result, its option volatility, its implied volatility, or its forward-looking volatility is priced high. What happens when a stock has high implied volatility? Well, it means the calls are more expensive. And that's great for a call seller, someone who's doing covered calls. So let's go back. We'll look at, go back to Robinhood one more time. We'll type in shop for Shopify. We'll take a look at its options. Let's go again about a month out, a little bit more than a month out. So it's currently priced at, the shares are trading at, let's see, 326 roughly. And the closest, these are slightly out of the money, but just for the purposes of our demonstration, it's okay. The closest strike that's above it is 330. These are trading at 2140. So we can even pretend that these are at the money. They're actually not at the money, so there's some profit potential here going from 326 to 330. But let's look at what this ratio is. 21.40 divided by 326. That's equal to 6.5%. So again, it's a lot of money. That's a great return over just 30, 45 days. I mean, if that's a 1 month return, you could do that 12 times a year. You're making 78% on your money. Little too good to be true for just selling covered calls. And so, as we said, this is above 5%. So beware. Then the next step would be, okay, we go to, we look at how shorted the stock is. We go to Shopify, go to Yahoo Finance, type in shop. We scroll down. And this doesn't seem to have, for some reason, oh, actually it does. The shares sold short as a percentage of shares outstanding, only 3.3%. So it's not a highly shorted name. That's good news. Let's say we've used Shopify before. We understand their business. Maybe we have an e-commerce site running on it. And so what we would conclude after looking at these at the money call options is that this is just a volatile stock. We can look at a chart of it. We realize the stock really bounces around a lot. Maybe it's overvalued. Got to be a little bit careful there. So we go back. We look at the summary. And again, you can do much more in-depth fundamental analysis. Let's just see what the PE is. It's probably has a fairly high PE simply because it's a high growth stock in a new space. So if we look at the PE, it actually doesn't have, it's been losing money. So it's been losing 71 cents a share over the last 12 months. So it doesn't have a PE. You can't have a PE ratio when you have negative earnings. So that's something to worry about. But obviously the company, the market is betting that Shopify is going to eventually become profitable. And right now they're just focused on growing their revenues. All of which is to say, don't be afraid of covered calls that pay you really well if you understand the underlying company. So if you think Shopify is fairly valued here, maybe it'll go up a little bit, down a little bit, but it's not going to crash, in which case you don't want to touch it, or maybe you want to buy puts on it. If you think it's going to go up a lot, again, you do just be long the stock. But if you think it's just going to bounce around sideways here, covered calls would make a lot of sense. You're going to be making 6% a month. That's awesome. And so calls, whenever you see calls that are priced really high, it either means it's a heavily shorted name or that it just has it bounces around a lot, so it has high implied volatility. Now, I should mention that it's okay to sell a call that is slightly in the money, as we saw with that Shopify example. So what we could have done in this case is the stock's currently trading at, call it 326, and there is a 325 call. We could either sell the 330 call, which is slightly out of the money. The 325 call is slightly in the money. We could still do this because it's fairly close to being at the money. In that case, the stock is going to be sold, could be called away from you at 325. So you'll have a capital loss. You'll lose about $1, 326 down to 325 if the stock's called away from you. But you're still collecting some of that back. You're actually collecting it back because $1 of this option premium is comprised of intrinsic value. This option is about $1 in the money, or it's technically, since the stock's at 326.86 and the strike price of this call option is 325, it's basically $1.86 in the money. And so by selling this call, you'll be collecting that intrinsic value, and if the stock is ever called away from you at a lower price, basically you make the 186 selling this call, and then you're going to lose the 186 when the stock is called away from you at 325. But you shouldn't be afraid to sell calls that are slightly in the money. So for example, if GameStop is trading at 506, you could sell the $5 call. Again, this is a distressed company, so we wouldn't, it's just an example. We probably wouldn't want to do covered calls on it. If GameStop is above $5 at expiration, the stock's going to be taken away from you at $5. That's going to create a 6 cent or $6 on 100 shares, short-term capital loss. But that's okay because you're collecting that 6 cents inside the call premium as part of the intrinsic value of that five strike call. Now, what happens to you if your stock crashes? Well, hopefully it won't crash. Coke, McDonald's, these kind of stocks generally don't crash unless you get an overall market crash. But what happens? Well, this is one reason you want to pick a company that you have high confidence in over the long term, and especially a company that's paying a dividend. So if your stock crashes, let's say you do covered calls on a stock and the stock crashes, well, what that means is the call is going to expire worthless. You're still going to own the shares. Maybe you have a big paper loss on them. But so what do you do in that case? Well, you can hold on and keep collecting the dividend, which is nice. That's one reason it's nice to have a stock that pays a dividend yield of somewhere between 2 and 3.5%. Right now, you're lucky to get 2% on your cash, so at least you're sort of tied up in the stock, but you're still making a good dividend yield, and you're paying a favorable tax rate on that dividend yield. The other thing you can do, so you can keep collecting that dividend if the stock pays a dividend, and then you can just wait until the stock gets back up close to your cost. So if we bought Coke at 53.78 and it crashed down to 45, just hold on, collect that 3% dividend, and then when it gets back up to 53.78 around there, we can start selling calls again. We're selling at the money call or slightly out of the money call. Maybe then we could sell another 55 call. You could also sell a long dated call that's close to your cost. So let's look at an example of this. So if we look at Coke KO, we go to look at trade options, and let's say that let's pretend that we bought the stock at let's say the stock's currently trading at 53.85. Let's say we paid like $60 for the stock. Now it's never been that high, but let's just pretend that we paid $60 for the stock. So we did the covered calls at 60, the stock crashed down to 53, that initial short call expired worthless, we just own the stock. Now I could wait till it gets back up to 60 and sell some calls on it then. Or the other thing I can do is I could just go out further in time. Now if I wanted, let's say I wanted to sell, let's rewind. Let's say I own the stock at 60, the stock's currently at 53, and I wanted to sell more at the money calls. Well, if I'm looking a month out, so let's look at, call it November 15th, we'll look at the 60 calls. Right now, because they're so far out of the money, they're only paying 5 cents. So probably not worth your time to do. But again, I want to sell them at 60 because this is how much I paid for the stock. So in that case, you can either wait until the stock gets back up close to 60 and sell some calls then, or you can go further out in time. So if I look way out, maybe I go out to May 15th, 2020. Excuse me. In which case, the May 15th, 2020 calls, the 60 calls, let's pretend I own Coke at 60, even though it's never traded that high. Now, if I sell those calls, I can make 68 cents. Now, 68 cents on $60 is not that great. That's about 1%, but at least I'll be collecting that 3% dividend yield. I'll make another 1% on this call while I'm waiting over the next, call it 9 months, from October to May, 8 or 9 months. And so that's the other thing you can do. You can go further out and sell a long dated call. You can even sell a leap, which is a call option that expires in a year or more. The other thing you can do, let's say you did covered calls on GE, you realize you made a mistake, something's changed with the underlying company, it's no longer a safe company. In that case, you just sell your stock. So you do covered calls on the stock falls a lot, the short call option expires worthless, you're just left with the shares. What do? Do you bet that GE is going to rally here from $8 a share back up to $60 a share? Probably not. You just you take your loss and you move on. But again, that's why it's so important to do that due diligence ahead of time and to look at the ROE, to look at the debt, to look at the long-term prospects of the company, so you don't run into a situation like this. But it'll occasionally happen. And one way to mitigate against this, if you have enough capital, is don't just do covered calls on GE or Coke. Do it on as many names as you can. So maybe if you have $100,000, you can do this on. Do $10,000 in Coke, $10,000 in McDonald's, $10,000 in Johnson & Johnson, and really spread it across a bunch of different stocks. You can also do what I call uneven covered calls. So let's say you own 1,300 shares of stock and you're slightly bullish on the company, so you don't want to give away the upside for all those shares. So maybe you sell just 10 calls at the money calls. And so you're basically doing covered calls on 1,000 shares. 10 calls is equal to 1,000 shares. And you leave that 300 shares just net long. You're not giving away any upside against those because you haven't sold any calls short against them. And so in that case, you make money. If the stock rallies, the 1,000 shares will be taken away at that strike price of your short call, but those 300 shares will continue to go up. And so maybe you can do some balance, some mixture of this where you're slightly bullish on a company, maybe a little more bullish, so you don't sell covered calls on all the shares that you own. And again, that 300 shares will now have more upside potential because you haven't sold away the upside in exchange for premium, but it's also going to have less cushion on the downside. because you didn't collect that premium up front. So that's the trade-off. Again, just to review, don't sell covered calls in a stock that you think is going to go up a lot. Also, finally, I would say don't sell covered calls in a stock that you have a long-term capital gain on that you're not willing to pay the taxes on, the capital gains tax. So let's say that many years ago, your grandpa gave you, when you were a kid, he gave you some shares of Coke, and Coke's currently at 53 something, and your cost basis, you own the shares at $2 a share. And so if you do covered calls on that Coke, and maybe you're ready to sell it, you've had a good run, you'd like to take your profits and put them into a tech company like Facebook or Apple, and so you're okay. Well, if the stock gets called away from you, you're going to have to pay taxes on that. You're going to have to pay long-term capital gains taxes on the stock. So if you own it at $2 a share and you sell it at $55 a share, you're going to own, on let's say you own 1,000 shares, that's $53,000 profit. You're going to have to pay 15, 20, 23% long-term cap gains tax on that. So if you have some legacy stock position that you want to hold on forever and maybe pass on to your kids or grandkids, don't sell covered calls on it. You only sell calls against a stock that you're willing to have taken away from you. That's basically the summary of covered calls. In the coming lectures, we'll talk a little bit more about variations on them, such as cash secured puts, which turn out to have the exact same risk-reward profile as covered calls.